You think your paycheck is money? You think a dollar in your bank account is a dollar earned, a solid unit of your hard work. But what if it's not? What if the money you earn is just a ticket, and the real game is happening somewhere else entirely? You're standing on the sidelines, holding your ticket, watching a game where the rules were written long before you arrived. The players on the field aren't just working harder. They are playing a different sport. They understand the system isn't built to reward the person who works for a dollar. It's built to reward the person who owns the machine that makes the dollars. This is the story of that machine. This isn't a conspiracy. It's just a design. A very old, very powerful design that has been humming along for generations, creating massive waves of wealth and, devastating crashes with predictable regularity. We're going to pull back the curtain on this machine. We will look at who really creates the money we use every day. We will explore why financial crises seem to happen over and over again. Most importantly, we will uncover how true wealth is compounded, and how you can stop being a spectator and start positioning yourself on the field. The game is already in progress. It's time to learn the rules. One works diligently for 40 years, saving a portion of every paycheck. She puts it in a savings account, thinking she is being responsible. The other person learns the system. He understands his income is the starting point, the seed capital. He converts that income into assets, things that generate more money on their own. He buys a small piece of a company. He buys a tiny fraction of a rental property. Over those same 40 years, the saver's money is slowly eaten by inflation, its power diminishing. The owner's assets, meanwhile, have grown, split, and multiplied, generating an income stream all their own. They both started with a paycheck, but only one understood the game. The difference wasn't luck, it wasn't genius, it was awareness. It was understanding the four pillars that hold up our entire financial world: U.S. Treasury, Federal Reserve, commercial banking system, capital markets. These aren't just boring institutions you read about in headlines, they are the gears of the machine. They dictate the flow of money. They dictate the cost of borrowing. They dictate the value of everything you own or hope to own. The first pillar is the U.S. Department of the Treasury. Think of it as the government's bank account and bookkeeper, all rolled into one. Bank account bookkeeper. Its most basic job is to manage the country's money. It collects taxes from you and me. It pays the government's bills, soldiers' salaries, asphalt for a new highway. But its real power comes from something else: its ability to borrow money on a scale that is almost impossible to comprehend. When the government spends more than it takes in through taxes, which is almost always, the Treasury has to make up the difference. It does this by issuing debt. This debt is sold in the form of Treasury bonds, bills, and notes. Treasury bonds, Treasury bills, Treasury notes. You might have heard of them. They are essentially IOUs from the U.S. government. When you buy a Treasury bond, you are lending money to the government, and in return, it promises to pay you back with interest. This sounds simple enough, but here's the key insight. Treasury bonds are considered the safest asset on planet Earth. Why? Because the U.S. government has the power to tax the largest economy in the world, and it influences the creation of its own currency. So it's seen as the most reliable borrower. There is virtually zero chance it won't pay you back. Let's use a concrete example. Imagine the government needs to fund a new infrastructure project that costs $100 billion, but it only has $70 billion in tax revenue. The Treasury steps in and issues $30 billion in new bonds. Big investment funds, foreign governments, individuals buy these bonds. They hand over their cash to the Treasury, and the Treasury uses that cash to pay for the project. The bond buyers now hold an ultra-safe asset that pays them a steady, predictable interest rate. This process happens constantly, creating a massive foundational market for debt that underpins the entire global financial system. The result is that the Treasury sets the baseline for risk everywhere. The interest rate on a 10-year Treasury bond is known as the risk-free rate. Every other investment in the world is measured against it. Mortgage on a house, loan for a new business, share of a tech startup. If you can get a 4% return from the US government with zero risk, why would you lend money to a risky new restaurant for anything less? The Treasury, by managing the government's debt, creates the fundamental benchmark against which all financial risk and reward are judged. It is the system's anchor. If the Treasury is the scorekeeper, the Federal Reserve, or the Fed, is the referee. It's the central bank of the United States, and its official job is to keep prices stable, manage inflation, and maximize employment. But its true power lies in its ability to control the cost of money itself. The Fed doesn't print cash in a basement, not literally. Instead, it influences the economy by setting a key interest rate, known as the federal funds rate. This is the rate at which big commercial banks lend money to each other overnight. It's the wholesale price of money, and it sends ripples through everything else. When the Fed wants to stimulate the economy, it lowers this interest rate. This makes it cheaper for banks to borrow money. Because their own costs are lower, they can then offer cheaper loans to you and me. Mortgages get cheaper. Car loans get cheaper. Business loans get cheaper. This encourages people and companies to borrow and spend, which juices up the economy. Conversely, when the Fed wants to cool down an overheating economy and fight inflation, it raises interest rates. Borrowing becomes more expensive, people and businesses spend less, and the economy slows down. The Fed acts like a driver with a foot on the gas and the brake. Here's a clear example of its power in action. Think back to the 2008 financial crisis. The economy was in a freefall. The Fed, in response, slashed interest rates to nearly zero. This was like hitting the gas pedal as hard as possible. It made borrowing incredibly cheap. But it did something else too. It started a program called quantitative easing, or QE. In simple terms, the Fed created new digital money and used it to buy Treasury bonds and other assets directly from the market. This pumped trillions of fresh dollars into the financial system, pushing asset prices, like stocks and real estate, skyward. It was a massive intervention designed to save the system. The crucial insight here is that the Fed's actions have a much bigger and faster impact on asset owners than on wage earners. When the Fed lowers rates and pumps money into the system, it doesn't just make it easier to get a loan for a car. It directly inflates the value of the stock market, real estate, and other financial assets. Someone whose wealth is tied up in a stock portfolio sees their net worth jump almost overnight. Someone who only earns a paycheck might not see a raise for years, if at all. The Fed's primary tools, while intended to help the whole economy, disproportionately and immediately benefit those who already own things. Now, we come to the pillar you interact with most directly: commercial banks. This includes the big names like Chase, Bank of America, and your local credit union. You think of a bank as a place that holds your money for safekeeping. You deposit your paycheck. The bank keeps it in a vault until you need it. But that's not really how it works. A bank is not a warehouse for money, it's a factory for it. The primary way it manufactures money is through lending. This is called fractional reserve banking. It's the engine of our modern economy. When you deposit $1,000 into your account, the bank doesn't just lock it away. It must keep a small fraction, say 10% or $100, as reserve. This is its reserve. The other $900 it can lend out. So, your neighbor Bob comes to the bank and takes out a $900 loan to buy a new lawnmower. The bank creates a $900 loan for Bob. At that moment, new money has been created. You still have $1,000 in your account. Bob now has $900 to spend. The money supply grew from $1,000 to $1,900. It wasn't printed, it was loaned into existence. Let's follow the money. Bob pays the lawnmower store $900. The store deposits the $900 into their bank. That bank has a new $900 deposit, It keeps 10%, $90 in reserve. It can lend out $810. Someone takes an $810 loan. The process repeats. Your initial $1,000 can support creation of thousands of new dollars across the system. Each loan expands the money supply. Each loan repayment contracts the money supply. Most money in the economy is bank credit, created digitally when loans are signed. This reveals a truth. Economic growth is driven by debt expansion. For growth, banks must keep making loans. The Fed controls how easy or expensive lending is. This controls new money creation. That's why banks sit at the center of financial crises. If loans can't be repaid, created money can vanish, triggering rapid contraction, a bust. Banks aren't just holding money, they create and destroy it every day. The first three pillars create and manage the money supply, and the fourth pillar, capital markets, is where that money is put to work to generate exponential wealth. Capital markets are the places where savings and investments are channeled between people who have capital and people who need it. The most famous example, the stock market. The other big example, the bond market. This is the arena where ownership is bought and sold. It's the high-stakes table where fortunes are made, not just from working, but from owning a piece of the action. Think of the stock market. When you buy a share of Apple, you are not just making a bet. You are purchasing a tiny fraction of ownership in the company. You are now entitled to a sliver of its future profits. If Apple invents the next world-changing device, its profits will soar, and the value of your ownership stake, your stock, will increase dramatically. You didn't invent the device. You didn't work in the factory. You didn't even manage the project. You simply provided capital. And for that, you are rewarded with a share of the growth. This is the core function of capital markets, to let people profit from businesses they don't run. Simple story, early 2000s, a young programmer starts a social media company in his dorm room. He has a great idea, but no money. He goes to a venture capitalist and sells 20% of the company for $1. That money lets him hire engineers, rent an office, and build his product. A few years later, the company goes public. That 20% stake, bought for $1, is now worth $5. The VC's money grew 5,000 times. This is the power of owning a successful asset. Capital markets are built for exponential, not linear growth. A salary grows linearly. A small raise, more hours. An asset can grow exponentially. It can double, it can triple, it can go 100-fold. This is where the great divergence in wealth happens. Most people chase linear income, while capital market players chase exponential growth through ownership. The system isn't just about earning money. It's about putting that money where it can multiply on its own, over time. The system doesn't operate in a vacuum. It sits atop a global foundation that gives it immense power, and that foundation is built on the US dollar. To understand why, we have to go back to the end of World War II. In 1944, leaders from the Allied nations met in Bretton Woods, New Hampshire. They needed to create a stable global economic system out of the rubble of the war. Their solution was to peg all major world currencies to the US dollar, which, in turn, was pegged to gold at a fixed rate of $35 per ounce. The dollar officially became the world's reserve currency. For a while, this system worked. But in the 1960s and early 1970s, as US spending on the Vietnam War and domestic programs ramped up, other countries grew nervous. They began to question if the US had enough gold to back all the dollars floating around the world. They started showing up and asking for their gold back. In 1971, President Nixon made a stunning move. He unilaterally severed the dollar's link to gold. The gold window was closed. From that day forward, the dollar was backed by nothing but the full faith and credit of the United States. It became a pure fiat currency. You would think this would have been a disaster for the dollar. It wasn't. By then, the dollar was so deeply embedded in global trade that there was no alternative. Oil, the world's most important commodity, was, and still is, priced and sold exclusively in dollars. This created a permanent, structural demand for dollars from every country on Earth. If Japan wants to buy oil from Saudi Arabia, it first has to buy US dollars. This global dominance gives the United States an incredible advantage, often called an exorbitant privilege. It can borrow money in the same currency it prints. What does this mean for an individual? It means the US can effectively export its inflation. When the Fed creates trillions of new dollars to stimulate the US economy, those dollars don't just stay within our borders. They flow out into the world, absorbed by the global demand for dollars. This allows the US to run massive deficits and accumulate debt on a scale no other country could manage. It creates a massive built-in cushion for the American financial system. While it can make goods imported from other countries cheaper for Americans, it also means the stability of the entire world's finances rests on the decisions made in Washington, D.C. Well, and that's a lot to consider. Now that we see the pillars, we can uncover the incentives that drive the machine. These aren't dark conspiracies. They are simply the logical outcomes of the system's design. The first and most important secret is that our economic growth is fundamentally dependent on debt. For the economy to expand, the total amount of debt must go up. Government, corporate, household. Think back to how banks create money, by making new loans. Without a steady stream of new loans, the money supply stagnates and the economy grinds to a halt. Growth equals credit expansion. This creates a powerful incentive for policymakers to keep credit flowing at all costs. Whenever the economy shows signs of slowing down, the immediate response is to make borrowing easier. The Fed cuts interest rates. The government might offer tax credits for buying a house. The government might offer tax credits for buying a car. The goal is always the same: encourage people and businesses to take on more debt. This creates a short-term economic boom. People feel richer. They spend more. Companies hire more workers. Everything looks great for a while. But this reliance on debt is also the source of the system's instability. It creates recurring boom and bust cycles. The boom is the period of easy credit and rising debt. Asset prices, stocks, asset prices, real estate, get bid up to unsustainable levels, fueled by cheap borrowed money. People take on mortgages they can't really afford. Or they speculate on stocks with borrowed funds. It feels like a party that will never end. Eventually, however, the debt becomes too large to be serviced. Or the Fed raises interest rates to fight inflation from all the new money. This is when the bust happens. As interest rates rise, borrowing becomes more expensive. The flow of new credit slows down. People can no longer afford their debt payments. Companies can no longer afford their debt payments. They are forced to sell assets to raise cash. But when everyone tries to sell at once, prices collapse. This is what happened in 2008 with the housing market. The boom was fueled by years of cheap mortgages. The bust came when homeowners could no longer pay. The value of their homes plummeted. The system's need for ever-expanding debt guarantees these cycles will repeat. The second secret is a direct consequence of the first. Because the system relies on debt and credit cycles managed by the Fed, its main policy tools are blunt instruments that primarily affect financial assets. When the Fed lowers interest rates or engages in quantitative easing, its goal is to make credit cheaper and encourage spending across the whole economy. But the transmission mechanism for this policy runs directly through Wall Street, not Main Street. The first thing to react is the price of stocks, bonds, and real estate. The effect on wages and employment comes much later, if at all. This creates what is known as an asset-first policy environment. The health of the asset markets becomes a proxy for the health of the economy. You see this every day in the news. If the stock market is up, commentators say the economy is strong. If it's down, they warn of a recession. This focus has a profound effect. It trains policymakers to prioritize the stability and growth of asset prices above all else. A sharp drop in the stock market is seen as an immediate crisis that requires an urgent response from the Fed. A decade of stagnant wages for the bottom 50% of earners? That's seen as a long-term structural problem with no easy solution. Let's trace the cause and effect. The economy starts to slow down. The Fed cuts interest rates to zero. This makes borrowing money incredibly cheap for large corporations and investors. A corporation can borrow billions at 2% and use that money to buy back its own stock. This reduces the number of shares outstanding, which artificially boosts the earnings per share and drives the stock price up. The CEO, whose compensation is largely in stock options, gets a massive payday. The hedge fund that owns the stock sees its portfolio value soar. The owner of capital benefits immediately and directly. Meanwhile, what happens to the worker? The company might use some of its cheap debt to invest in automation, which could eliminate jobs. The worker's paycheck doesn't automatically go up just because interest rates are low. Their savings account, now earning 0.1% interest, is actually losing purchasing power to inflation. They see headlines about a roaring stock market, but their personal financial situation hasn't changed. This isn't because the Fed is malicious. It's because the tools it uses, interest rates and asset purchases, are designed to work through the financial system first. The benefits flow to asset owners first, and only trickle down to wage earners much later and much less powerfully. The third secret is a cultural one, but it's hardwired into the system's code. We are taught from a young age that the path to financial success is to work hard, be diligent, save your money. Hard work is a virtue, but in a system designed to reward owners, hard work alone is not enough. The system does not primarily reward labor, it rewards capital, and more specifically, capital that takes calculated risks. The biggest financial rewards don't go to the person who works the longest hours, but to the person who successfully deploys capital into a growing asset. Think about the difference between income and wealth. Income is what you earn from your labor. It's active, you have to keep showing up to get it. Wealth is what you own. Assets that generate income or grow in value on their own. It's passive. The goal is to convert active income into passive wealth as efficiently as possible. They use paychecks as tools to buy assets, stocks, real estate, a piece of a private business. Every dollar put into an asset is a soldier sent out to fight for them. This is where risk comes in. Savings accounts, near zero risk, near zero reward. Inflation slowly erodes that value. Treasury bonds, very low risk, small stable reward. Stocks, involve risk. The company could fail and go to zero, but they offer potential for enormous reward if the company succeeds. Capital markets are an arena for pricing and taking risk. The system gives outsized returns to those who take intelligent risks with capital. That's why tech founders and investors can become extremely wealthy from single bets. They weren't just working hard, they allocated capital to unproven but promising ventures. Their reward, not a salary, but a massive multiplication of ownership. This isn't a call to gamble your life savings. It's a call to shift your mindset from worker to owner and to take calculated, intelligent investment risk with a portion of your capital. For decades, the standard financial advice has been, focus on your income, get a good job, ask for a raise, climb the corporate ladder. This is the worker's path. It's optimizing money for time. A good income matters, but it's only half the equation. A high income can put you on a treadmill. You're running faster just to stay put. Inflation rises, asset prices climb faster. You may earn more, but fall further behind. Focus on your position. Think like an owner. Ask different questions. Instead of, how can I earn more? Ask, how do I convert earnings into self-growing assets? See your paycheck as raw material. Buy small pieces of ownership. Put capital to work with system incentives. Start building your position. First, convert income into assets. Automate savings. Automate investments. Direct paychecks into assets like low-cost index funds. Second, watch Fed interest cycles. When rates are low, borrowing is cheap and assets rise. When rates are high, borrowing is expensive. Hold cash and wait. Third, avoid high-interest consumption debt. Credit card debt pays the bank, not you. Finally, think globally. The US dollar won't last forever. Diversify some assets internationally. Optimizing paycheck versus optimizing position. Huge difference. One keeps you trading time for money. The other makes you a partial owner. Money works for you. The choice starts with awareness. The system is built to make owners rich. Most people spend their lives optimizing income. The wealthy optimize position. One works inside the system, the other aligns with its expansion. The difference isn't intelligence, it's awareness. If you don't understand how money is created, how interest rates shape markets, how global capital moves, why asset prices inflate faster than wages, you will mistake structural outcomes for personal failure. The system isn't personal, it's mechanical. If this shifted how you see money, don't let it end here. Like this video so more people understand the structure behind their paycheck. Comment inside if you feel trapped by the system. Comment aligned if you're learning to leverage it. Subscribe to Hidden Systems for weekly breakdowns of money, incentives, and global power structures. Because once you see the system clearly, you stop reacting to it and start positioning within it.